From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for Valentine's Day 2025. On the calendar, the Bucks return home Thursday the 20th for a game with the Clippers and the Admirals. Well, they're home next weekend. This Saturday, it's Cedarburg Winter Festival, which is always fun. And finally, if you're currently single, there's a singles party at the 3rd Street Mall. Hey, it's a singles party at a mall, so you can window shop, so to speak. We do a variation of this story every year. From various cities around the country, today it's connected in New York. A local aquarium has a fun Valentine's Day fund. They're raising money in the most peculiar way, unless you're a cockroach. For $1, you can sponsor a cockroach, have it named after that special someone, like an ex-boyfriend, and the staff will feed it to one of the reptiles at the aquarium. It gets better. You can videotape the last few moments of your cockroach's life so you can watch it over and over again. A Japanese tech company lets workers drink on the job and offers hangover leave. The unusual recruiting strategy is luring Gen Z workers. And there has been zero turnover, despite very low salaries. I hope HR is listening. And finally, in China, celebrating a Lunar New Year, the firecracker explodes in a woman's mouth. She thought it was candy. She's going to be all right, but she'll need to put her food in the blender for a while. On the podcast today, we have Kendall, Bauer, Steve Giles, and Joel Dreesang. And wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. A special Valentine's Day podcast for all our listeners. The NASDAQ, a pretty amorous week, up 2.6% this week. That's 503 points, closing at the bell at 20,027, back over the 20,000 mark for the NASDAQ. The S&P 500 up 1.5% this week. That's 89 points, despite a very small decline on Friday, closing at the bell at 61.15. And the Dow Jones Industrial Average up 0.5% this week, despite a 165-point decline on Friday, up 243 for the week, closing at the bell in New York on Friday at 44,546. For the year, NASDAQ up 3.7, the S&P up 4, and the Dow Jones Industrial Average is still pretty robust, 4.8%, as we're now a month and a half into the new year. Joel, maybe start with you today. We got a CPI number on Wednesday. I think that momentarily caused markets to panic. It was more or less what we expected, that inflation's certainly not gone, that we're still dealing with remnants in places. And I think the market slowly digested the news that maybe it wasn't all bad. But at least temporarily, the information started to create a little bit of a concern that, maybe inflation's on its way back up.
It's one of those things where, the experts were expecting it at one point, and it came up a little higher than that, and that sort of upsets everybody right away. But it's inflation is showing itself as being stubborn. It got down to 2.4% in September, and the Fed target long-term is 2%, so that was getting pretty close. And remember, it was 9% back in mid-2022. But lo and behold, it's gone up 4 months straight now, and it's at 3%. So it's going in the wrong direction. It's still not 9%, but it's still, not where the Fed wants it to be.
So how much, Joel, of that number is inflation being stubborn or consumers being stubborn? As much as we continue to complain about the prices of everything being higher than we want to pay, we certainly keep opening up our wallets.
Yeah, Steve, one thing that's interesting is shelter. Shelter costs ate up a large percent of that increase in January and yet shelter costs year to year are up 4.4% compared to that overall inflation number of 3%, and that's the lowest year-to-year increase in shelter costs in more than 3 years. So so that's still a problem. Kyle, you bring this up every week on the podcast to say that's something that we need to concern ourselves with in the economy is just those shelter costs.
I was just about to say that, Joel. And, I think as we as we get into some of the nuance sometimes of the inflation data, I think it's easy to point to here's the one or two things that are a problem. Here's the 4 or 5 things that look a little better than what they used to look like before. I think as I kind of digest where are we headed, where are things going, still signs that, in some areas things have settled down, and in others we're still dealing with some of that pain. Insurance was one of the headliners, auto insurance in particular, in terms of kind of the biggest growth. At the same time, we've seen some pullback in energy prices and food prices in some areas. And again, then we still talk about the price of eggs. So it's always fun to kind of play that game of nuance.
Eggs were up 15% just between December and January. They're up 53% from January a year ago. So, you can single out little things like that, and eggs are little as far as the whole overall cost of living, but they're things that get people's attention.
Absolutely. Kendall, one of the things that caught my attention on Wednesday was that quick spike in the 10-year Treasury. We had largely been in a pretty narrow range for much of the year on the 10-year Treasury, seeing some occasional spikes and pullbacks. But, the challenge has always been that when we see some fear of inflation, we go back to where we were in 2022 when interest rates were flying higher quickly, and it caused our bond funds to decline pretty rapidly. And I think there's still some kind of trauma near term for investors when they look and go, oh, inflation's not cured. Does it mean my bond funds are just going to fall apart? Yeah, we got a little reprieve on Wednesday, but what do investors need to be paying attention to with the bonds?
Yeah, I think this time around may be a little bit different because we have certainly a lot more cushion in the form of yield on those bond funds. I think that's what hurt the most in 2022 with bonds is, we had come out of a decade plus of 0% interest rates. So there was no cushion in the form of yield to soften that impact with the 10-year spiking the way it did. And yields are still, I think, pretty great. Look on the duration scale, but short-term side, for example, still seeing pretty attractive yields. You have the Fed kind of tiptoeing now about rate cuts, and that I think further benefits some of the shorter-term debt instruments from a yield perspective. So, I think a little bit different story this time around with the 10-year jumping, maybe a bit of an overreaction to the CPI number, but don't lose sight on the fact that where we are today is a completely different space than we were 3 years ago.
And I also think it's interesting, Kendall, that for everybody that I hear complain about rates being stubbornly high and the Fed should move them lower because they want to buy more houses and cars, I hear another person that's thrilled about what their savings account is paying them, what CDs are paying them, and the yield that we have been missing for the better part of 15 years is finally back and is now a real part of an investor's portfolio, and it's giving us some choice out there with respect to interest.
I think investors often miss the point of bonds overall, which is not to have those outsized potential price returns, but simply to clip a coupon. And in the zero rate world that we were in 5 years ago, those coupons were exceptionally low. And now all of a sudden, Steve, to your point, those coupons are a lot higher. I'm ecstatic in a year in which all we do is clip a coupon if that coupon's 4.5% or 5%. And I think if we do see those rate cuts that so many I think we're hoping for, you get that short-term bump to your bond portfolio in terms of higher prices. Remember, of course, that the relationship between bond prices and interest rates is inverse. And so when rates are falling, the price of your existing bonds tends to go up. But also, it means that those coupons in the future are going to be a lot smaller than the ones we're getting right now. And so I think it is that kind of that very narrow edge to walk, that very sharp edge to walk of, we'll take a little gain here if rates come down a little, but too much, and we're really shooting ourselves in the foot long term about what that means for our portfolio.
If we wait long enough too, Kyle, investors and savers will get used to rates where they are, and I think the Fed recognizing that if we wait long enough, we'll sort of renormalize to where we were maybe 20, 25 years ago. I mean, I still have clients that tell me stories of when they bought houses in the 80s and they were thrilled to lock in a mortgage in the low double digits. So we've come a long way from that, but in terms of perspective, I don't think that the 10-year at 4.5 is all that bad.
I don't think it is at all. And, I think maybe now's the time to get a little bit in the weeds as well and remind investors that if bonds are the safe piece of your portfolio, keep it safe, because there are areas of the bond market that offer a little more attractive yield, but do so with a lot of risk. And it's a reminder that right now we're seeing near record tights for high yield spreads. What that means in very simple terms is the extra interest that you're getting paid to buy those lower quality bonds is about as low relative to the higher quality bonds as we've seen in the history of kind of those measurements. And so when we go back and go, well, what's a good time to maybe take a little more risk in the bond piece of our portfolio? It's when you're getting compensated to take that risk. And right now it's clear you're being paid pretty well not to take the risk. You're definitely not being compensated well enough to take a lot more. And so, yeah, maybe a little bit on the margins for those that want something that looks a little different. But I wouldn't be going out of my way to track down those much higher yields.
Yeah, I think good reminder too not to chase returns, right? In this specific piece too with bonds, it's maybe you can earn a couple more percent in high yield relative to some of the short-term things, but you have to remember it works both ways. If things get ugly, you're going to feel the pain of that more risky piece in high yield, for example, than you would maybe in a shorter duration, more high credit quality bond fund.
I think that's fair. Steve, it's about a 75% of the way through S&P 500 earnings season. It's all about earnings and interest rates. And I think, if anything, the market has reflected the fact that rates have been steady. So you can take that out of the equation right now when you're talking about, okay, what are our expectations? And earnings have come in far better than expected. We've been talking on the podcast for some time about how stocks are a little expensive, maybe a little more than a little expensive. And yet, despite a S&P that's up 4% this year, kind of our measures of valuation, whether it's looking at forward or trailing or any of the kind of more in the weeds numbers, haven't changed all that drastically because earnings have kept up.
Yeah, they absolutely have kept up. You've got revenue growing at 5%. We're about 20% better than expectations. Double-digit earnings growth forecasts for 25 and 26 have stuck so far. You've got forward earnings growth forecasts that have helped to keep those PE stable. And even though they're elevated, stock prices have still moved higher. I think it's a good story to tell.
And I think, the uncertainty that we often deal with, Kendall, is part of the conversation, right? That how do we navigate whatever today's news is that might lead you to believe that maybe tomorrow's going to be a little better or a little worse. And again, yet we have this kind of strong earnings forecast that's carried the day.
Yeah, absolutely. I think long term, it's always been about earnings and interest rates. I mean, we've heard that phrase repeated. I would love to know the amount of times over the history of this firm.
If you had a nickel.
Yeah. But no, to your point, I think, short term, all sorts of things can happen, right? And oftentimes it's those things that come out of left field that bump us into a correction or a pullback. But long-term fundamentals will continue to be, that driver. And I think last year, interesting to see, a year in which we, expected maybe a little more volatility, generally speaking, in an election year. But strong fundamentals led us to another great year for stocks last year, right through that. I think important to keep your eye a little bit further down the road, but doesn't mean,
Well, and when you think about the forward PE being over 22, which is higher than that historical average, there's only two ways for that PE ratio to become average. Either the P changes or the E changes. So from a price standpoint, either the market comes down to correct on the valuations or the earnings come up. And what we've had over the last earnings season is the earnings have come up, which is why we're seeing the numbers that we are.
And I would add that maybe the number that we're using as average understates the real potential that's out there for the S&P right now, that S&P businesses are more profitable than they've ever been. not just in terms of that earnings number, but in terms of the actual profit margins in the underlying businesses, in part because of a conversation, Joel, that maybe we can move into here with respect to manufacturing in our country. Manufacturing going back 40, 50 years was 20 or 25% of our economy. Now it's 10% of our economy. And so if you're making less physical goods and more of our economy tied to services and the maybe technological goods, right, the information systems that we sell so much, well, maybe the numbers we get on manufacturing aren't quite as significant to the economy overall. We got a number on industrial production, some good news, but again, maybe not as significant of a contributor to our economy as it used to be.
Yeah, it was like Steve was saying, or what we were saying before about expectations and people just sort of having one expectation of how important manufacturing is because that's how it used to be, or the valuations of stocks, how it used to be might be different, might be changing. But yeah, so we had good numbers on industrial production in that it went up for the second month in a row. The output that manufacturing and mining industries and utilities have, but about 40% of that was a one-off. It was from more aircraft being made by Boeing after the strike ended and workers went back to work. So that little one-off kind of set things up. On the other hand, manufacturing for automotive stuff went down in January, so that wasn't that great. And really the thing that really buoyed the numbers for manufacturing in January were utilities. January was an extraordinarily, unseasonably cold month, and so utilities were putting out more to help people keep their houses warm.
And then we got a number on retail sales this week, and January is a similarly interesting month for retail sales, in part because we traditionally compare month over month. And December is a really big month for retail sales, and then all of a sudden you get January and the snowstorms and the cold and not Christmas and all the other holidays that come along that time of year, and all of a sudden you've got a very different picture.
There was much ado made today about the retail numbers coming in lower than they were in December. And I actually happened to look back at what they were a year ago, and they also went down in January because of two things. One is that a lot of people did their holiday shopping in November and December. Come January, they didn't need or want to spend as much. The other thing was weather. And we had the same thing this year with the wildfires out west, with the cold weather I referred to, in other parts of the country, which kept things like car dealerships, kind of behind on their sales as they used to be. But it's a volatile category, retail sales. We see ups and downs all the time. This one was a little extraordinary, a little dramatic, but overall, we're still marching our way up.
And as I look ahead to what's coming next week and beyond, we still have 25% of the S&P 500 earnings for Q4 to be reported, including some big names like NVIDIA. So I think a lot of news still to come on the earnings front. You add in the Fed's going to release the minutes next week from their January meeting. And for a podcast that I think we mostly devoted to earnings and interest rates today, a lot of big news still to come in terms of kind of how the Fed's viewing interest rates and where earnings are headed. With that, we'll put an end to a Valentine's and Snowstorm Day podcast. We all need to get out of here, and I got to pick up chocolate, flowers, and windshield washer fluid on the way home. Does anybody know a single store that might offer all three? Normally, Max would be the 7-Eleven, but Quick Trip seems to have taken over our region. So with that, we enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.